Hans-Guenter Redeker is Global Head of Foreign Exchange Strategy at Morgan Stanley, joins me live now. Thank you very much indeed for speaking to us. Mr. Redeker, I actually wanted to start by asking you about Bernanke's comments in general. I mean, a pretty tough, if not toxic mix we have right now of low growth, high inflation. What did you take away from his comments?
Well, this stagflationary environment is definitely not a good sign for risky assets, and you see that the FX markets are trading accordingly. But I found it as well quite interesting what the Beige Book was saying, and a previous comment by Bernanke in which he was asked what he would or how he would see the current growth slowdown. What was the reason for this growth slowdown? And he mentioned two reasons. One was the supply chain interruption because of the earthquake in Japan, and secondly, the disposable income effect, the real disposable income effect coming on the back of higher pump prices. And as we all know, that there's a relationship between the US dollar and the price of commodities. And what could be in the short-term interest of the United States is to give real disposable income a boost by stabilizing the US dollar in the short term. And you add on that type of outlook the uncertainties we have currently in Euroland, and as well the slowing economic tendencies you see in Asia and as well in Euroland itself. And then you have a substantial decline in the euro.
I mean, the argument has been, hasn't it, that higher food, gas, transport prices are temporary. Did you sense any change in his tone on inflation?
Well, I guess that the central bank is becoming a little bit more worried. I mean, all in all, we have to admit that core inflation numbers are still very low. But the question is, what type of view are you going to take? Is it the Fed's view or is it the ECB's view? Now, both the central banks are differentiating pretty much in the interpretation. The ECB thinks that headline inflation is important, and the Fed believes it is only core inflation what matters. But what is a matter of fact is that over the recent few months, the increase of gasoline prices had a negative impact on real disposable income in the United States, according to the analysis of the Fed, and that, I guess, needs to be removed. And under those circumstances, I guess, you have, or in this context, you have to interpret the recent statements from the Federal Reserve.
Now, Hans, you said that markets are trading accordingly. Can you elaborate a little bit on that, and also on what the end of QE2 will mean for the currency markets, and more specifically for the dollar? Will the dollar benefit, in other words?
Yeah, so what we are currently having and most likely to see is that the Fed is going to stop adding to its balance sheet, and you have as well the Asian liquidity situation changing. We have pointed that out in recent research notes. When you look at money supply in Asia, or even only money supply in China, so M2 in China is now much higher than the entire M2 level in the United States. And that actually means the wall of liquidity had been created in Asia, and this wall of liquidity is now as well reduced because of the Asian monetary policy. There's a tightening underway. And on top of that, you have the Fed no longer expanding its balance sheet. So that means you will have less liquidity in the system. And when you have an environment where there's less liquidity in the system, it normally benefits the US dollar and is negative for currencies.
Is the end of QE2 enough of a reason, though, for the dollar to rebound? I'm thinking about investor concerns about the state of the U.S. economy right now, all the concerns that Bernanke raised in his press conference.
Well, it is a necessary but not sufficient condition. And what I said before, you need to have on top of this tightening moves in Asia taking place. Under those circumstances, you will get a dollar rally. And it looks like that those circumstances are there. So it means the necessary and sufficient conditions for a dollar rally are in place.